Hello friends, welcome to the Shikhar series. Shikhar series for BFM. Actually, in Shikhar series, we are covering all the subjects. Right from your ABM, BFM, ABFM, BRBL. And we are covering important theory and objective questions, everything. So, watch the series till the end. Watch it completely. Watch this video also. Watch it till the end because very important topic is covered. Treasury products. These treasury products and derivative products, similar ones. Okay. These two are related to each other. So that's why watch it completely. So let's start. See, this is a theory topic. Okay. Let's start with the first question. Consider the following statements regarding CBLO, collateralized borrowing and lending obligations, and choose the correct ones. So here you have to choose the correct ones. Now what do you mean by this? Correct ones. So this here it means that you have to look at, basically you have to look at these questions. Now the important part in this, what is CBLO? That is the main question. CBLO is basically for the NBFCs. Okay, NBFCs and everyone who can't take part in the T-bills, treasury bills. For them this route has been opened by RBI. NBFCs, cooperative banks, so they can enter into the CBLO arrangement. See here, T-bills purchasing and buying means OMO you can call it or repo transactions you can call it. That can be done only by the banks. Now what should the NBFCs do then? How should they function? They also need cheap money, right? T-bills and everything, basically OMO operations, they give you the cheap money. Cheap money means money at a lower cost, at the benchmark rate. Now similarly, NBFCs will also need the same because they have to run the business. For them, RBI started, I think so in 2001 they started. They started the CBLO. Through this, even these NBFCs, they can also enter into this separate market, buy the commercial papers from the private entities at the lowest rate. Okay. So that is basically CBLO. Okay. So, which of the statements is true regarding CBLO? It is traded in the secondary market. It can be readily encashed at the requirement of the lender without waiting till the due date. Settlement of CBLO takes place through Clearing Corporation of India. Now, important part over here is, look at this. Understand the terms properly. It is traded in the secondary market. Secondary market means what? There are two markets. One is primary, secondary. Primary means whenever you get it directly from the issuer. Okay, then you get it. This is primary market. Now here, when I trade between the dealers, means suppose if I purchase the IPO and then I have sold it. So then it comes, what it comes is this. Okay. Yeah. Say this, when I get it directly from, the issuer means, let's say, it's like the IPO, okay? It's like this IPO. In IPO, what do we do? In IPO, what do we do in IPO? In IPO, you will know that we get it directly the shares from the primary market, okay? So that is IPO. Whenever you get it directly from the issuer over here, that's known as the primary market. Issuer. Then it is known as A gets it. So this is primary market. Now from here what happens, this A will purchase it from the issuer or this company directly. A will sell it to B. So this is secondary market. Okay. So whenever the dealer or the broker sells to somebody, that's called as a secondary market. So it is traded in the secondary market, done. That's right, because that is the basic logic of this CBLO. In fact, the same logic goes for repo also. Okay? It can be readily encashed at the requirement of the lender without waiting till the due date. Readily encashed. Readily encashed means what? Till the due date. What do you mean by due date? This is similar to that of the bonds. In bonds also, whenever you purchase something, like this, whenever you purchase any bond, okay, so this bond is traded in the secondary market. Similarly, CBLO is traded in the secondary market. We deal in debentures generally, CPs, commercial papers. So if I purchase it from somebody, some A party, okay, I am purchasing it. Okay, so this is B, I am purchasing it. So I need not wait up till the maturity of that bond to get the money. I can sell it immediately to C also. That's the basic logic of this secondary market. Okay, so it can be readily encashed at the requirement of the lender without waiting till the due date. Settlement of CBLO takes place through Clearing Corporation of India. Now this is very important. What is the use of Clearing Corporation of India? Kindly note, Clearing Corporation of India is responsible for taking the settlement risk in their hands. Your credit risk part is taken care of by CCIL. Okay, credit risk means what? That the party will not pay you on the maturity date. That is known as credit risk. So that is taken care of by the CCIL. Okay, so takes place through CCIL. So that is also true. So the answers are this 1, 2 and 3. Okay. Kindly note the terms are important. Understanding the terms are very important. Okay. T-bills are to be held in dash account maintained by RBI, and secondary market settlement of T-bills takes place through dash. So these are your questions. T-bills are held in dash account. Which account are the treasury bills held? Now treasury bills mean this is related to your banking, because NBFCs are not allowed to deal in T-bills. Okay, that's why we have CBLO for them. So treasury bills are held in dash account. Which account? SGL account and maintained by RBI, and the secondary market settlement of T-bills takes place through Clearing Corporation of India, or is it current account and fixed income, FIMDA, savings account or Banking Regulation Act? So T-bills are held where? Think of it, everyone. Important question for your exam. Where are T-bills held? Means where do I keep the T-bills? Like here, what is this? This is similar to your Demat account. I buy the shares, and where do I keep the shares? I keep them in my Demat account. Similarly, these T-bills when I buy, I have to keep it somewhere. So where do I keep it? Yes, it is CCIL. Okay, this is the answer. T-bills are kept in SGL account, Subsidiary General Ledger. This SGL full form is Subsidiary General Ledger. Okay, Subsidiary General Ledger account. This is where we keep these T-bills. Okay, and Clearing Corporation, the settlement takes place through Clearing Corporation. Remember one thing, Clearing Corporation of India has been set up by the government. The basic logic of that is to cover the credit risk of any bond. Credit risk means what? Here, there are three risks basically in any market: credit, market and ops. So ops risk, operations means your own internal risk that can be taken care of by your own organization. Market risk is a market risk means not in the hands of anyone. You can only manage it. You can't control it, or you can't zeroize it. Credit risk is the risk that the party, suppose if I buy the FD from you. What is credit risk? Suppose if I buy FD from you, means what? I open an FD account with you, with your bank. Tomorrow your bank will say that I won't pay you now on maturity. On maturity, I'll be needing the FD money, right? So your bank may say that I won't pay you the FD now. That is known as credit risk. Also, simple way, suppose if I give you the loan, or you give the loan to anyone, that person says that I won't pay now. That is credit risk. So that is taken care of by the Clearing Corporation of India. Okay. So the T-bills are held in SGL account, and this settlement is done through Clearing Corporation. Which among the following is a major difference between OTC and exchange traded derivatives? Which is the main difference between OTC and exchange traded derivatives? Now think over it. Let us read this first. OTC derivatives are cheaper compared to the exchange traded derivatives and are costly. Means cheaper as compared to the ETC, and are costly. Costly, let's remove this. Are cheaper as compared to the ETC. Okay. Second, OTC derivatives are mainly for customers, wherein exchange traded derivatives are for the banks. Third, in OTC derivatives, counterparty risk is considered prominent, but in exchange traded derivatives, counterparty risk is absent. OTC derivatives are generally for hedging risks, whereas ETC derivatives are mainly for use for speculation. Now, all of them seem to be correct. Suppose if you see anyone, you'll see that every answer seems to be correct. OTC derivatives are cheaper and compared to the ETC derivatives. We tend to feel that yes, this is right, because why? What is OTC and ETC? OTC derivatives are between two parties. Kindly note, between two parties, bank and the customer. Only two parties are there. Okay? And ETC derivatives are between three parties, bank, customer and exchange. So bank, customer, and in between there is the exchange. This exchange controls the rules. Okay? So in between there is exchange. So OTC is between two parties, ETC is between three parties, where the exchange controls all the rules of the game. So that's why what happens, exchange is taking the credit risk over here. Similar to that CCI, that earlier example which I gave, CCI, same logic. Okay? Now, are OTC derivatives cheaper? Nothing like it. It's nothing. Derivatives, the cost of the derivative depends on the inherent risk in that derivative. Okay? So this is wrong. OTC derivatives are mainly for customers, whereas exchange traded derivatives are for banks. Nothing like this. OTC is for customers and ETC is for banks. Nothing of that sort. Anyone can be ETC, anywhere can be OTC. Okay? I'll give you a simple example. This ETC. You buy futures and options in the market. Stock market, we have futures, options. Now that is bought by anyone. That is ETC. That is derivative and that is ETC also. Why? Because there is NSE in between. Isn't it? So it's nothing like this. That OTC is for customer, ETC is for the banks. Out. Okay, so this is also out. Next, in OTC derivatives, counterparty risk is considered prominent, and in ETC, counterparty risk is absent. This is something which you can think. What did I say? OTC is between two parties. ETC is the exchange. So exchange takes the settlement risk, similar to CCIL. Right? Suppose if OTC means what? Suppose let's say simple example I'll give you. If you give loan to the customer, any customer you give the loan, there is a credit risk involved. The customer might say someday that no, I don't pay, I don't have money. It can happen. So that is basically OTC. There is always a credit risk involved in this. Next, ETC, the credit risk is lesser. Why? Because there is a third party in between. It's like the broker. Okay, or any middle person. So that person is like the court or the police. Will say, these are the rules. You decided this to pay, you decided this to sell. Both have to perform your duties. And it takes before the deal only, it takes some amount with it. So if there is a problem tomorrow, it can take care of this transaction. Okay. So that's why in ETC products, the credit risk is nil. Always, credit risk is absent. So this is the right answer. But what is the last one? OTC derivatives are generally for hedging the risk, whereas ETC are mainly for speculation. Nothing of that sort. Huh? Nothing of that sort. Let it be OTC, let it be ETC. Derivatives are there for hedging. Simple. Derivatives are there for hedging. Nothing is there for speculation. As at least in the books. Theoretically, I'll tell you, derivatives are there for hedging. They are not for speculation. Theoretically. Practically what happens is separate. Now after all, that's a greed. But people lose money also. How many of you, let me ask you, how many of you might have traded in futures and options? Options, many of you might have traded. बहुत पैसा बनता है, बहुत पैसा बनता है. 10,000 का बनता है, एक दिन में 20,000 बनता है, एक दिन में. There are available on YouTube ना, these guys. Double, 2 दिन में पैसा double. Trade in derivatives, trade in this options. Nothing, never go for this. That's why SEBI always tells you, go for the SEBI registered, right, that consultant. Don't go for anyone else. There's nothing in this world. Remember, nothing in the world comes fast. Fast come is fast go. Simple rule. Okay. So nothing is there for speculation. It is always for hedging. Okay. Which of the following statements regarding the treasury are true? So regarding the treasury operates in interbank markets which are free from credit risk. Think, operates in interbank markets, these are free from credit risk. Number 2, treasury is highly leveraged as risk capital allocated is 2 to 5%. Highly leveraged. 2 to 5% of the transaction size. And statement 3, operational cost of treasury is very high. So which one of them is true? No? We want true. Yeah. In exam always check what do you want? You want it true or false? Because what happens? You might know the answer. And what happens? You answer, they've asked you false, you answer true. Don't do that. Okay? So which of them is true? Check everyone. Treasury operates in interbank markets which are free from credit risk. Does treasury operate in free from? Many of you will think that no, how is this possible? Credit risk is always there. How can treasury operate in risk-free market? How can it operate? But mind it, treasury always operates in bonds. Or just now you saw that na? CVLO for NBFCs and T-bills for banks. Both of these are covered by whom? T-bills and CVLO. Both are this risk, credit risk is covered by whom? CCI, Clearing Corporation. So in this, Clearing Corporation is taking care of the credit risk. There is no credit risk involved when your treasury deals in interbank market. If some treasury does something out of the box, or why out of the box? Out of the regular way. It buys some bonds which are not at all traded on its own. हिम्मत है, बहुत डेयरिंग, मुझे डेयरिंग करने का था. There was a dialogue. Why did you do? There was one series on Netflix. In that he asked that तुमने ये सब क्यों किया? He says अपन को डेयरिंग करने का था. If you want to do daring in life, such mishaps happen. Never do daring in life. Okay? Always take the calculated risks. Calculated, very important word. Okay? Don't go for any daring buzz. Nothing happens. These heroes, daring heroes are only in movies. Practical life, if you do something, you'll have to sell your own house. It's that simple, isn't it? So, Treasury operates in interbank markets which are free from credit risk. True. Treasury is highly leveraged as the risk capital allocated is 2 to 5% of the transaction size. Highly leveraged. Firstly, what do you mean by this word leverage? Understand the word leverage. Here, there are 3 words in banking. Okay. One is hedge. Second is leverage. Very important words. And third one is arbitrage. The whole treasury operates on these three words only. Complete treasury operates on these three words. Okay? Complete. Hedging means what? Reducing. Reduce the risk. Reduce the risk. Okay? Reduce the risk. Leverage means increase the risk. Increase. Yes. Okay? Leverage is increase the risk. Means what do you mean by this leverage? In yesterday's introduction to treasury, I gave you this example of leveraging. Okay? Kindly watch that. Very simple. I'll take, let's say, gold loan from you. Okay? I'll take gold loan from you for, let's say, 10 lakhs, 5 lakhs, let's say. I'll take gold loan from you 5 lakhs. You'll give me how much? Around 70% bank gives, 70-75%. So I'll take 70% gold loan from you. I'll give you 10 gold worth 10 lakh rupees. Take 7 lakh loans. From that 7 lakh, I'll again buy gold. Again bring it to you. Again I'll get 70%. So 4,90,000. Again new loan. From that 490, what will I do? I'll again buy gold. And again take 70%. Again, I'll go on and on and on up to the time I get 0. What am I doing? From one gold of 10 lakhs, imagine what is the loan I have taken. It goes to more than 20-25 lakhs, 20 lakhs almost, if you count it, add the total. Very risky. So, treasury business is very risky, to be frank, because the capital cost allocated is only 2 to 5%. Only 2 to 5%. Then you'll say, sir, if such risky is a business, why do we have this treasury? We should not have the treasury then. But kindly note, there are also the hedging part to this. If I am increasing the risk by taking this 2 to 5%, I am also having other derivative products which will reduce the risk. Everything is there. Okay? So treasury is a well calculated business, kindly note. Treasury always operates in credit free, market free, means risk free instruments. Maximum it tries to do that. Because after all, why? The logic is here, whenever you are in banking, it's not your own money. You are dealing with the money of the depositor, someone else's. So whenever you are dealing with someone else's money, you have to be more cautious, isn't it? So this is true. What about the third one? Statement 3. Operational cost of treasury is high. This is wrong. Totally wrong. Operational cost of treasury is very, very, very low. Look at this only, 2 to 5%. If I am doing the transaction of rupees 100, I am giving only 2 rupees as the cost. Is it high? Compare it with the banking. If you have to earn rupees 100, how much have you to invest? Whereas in this, for earning rupees 100, I am investing only 2 rupees or 5 rupees. So operating cost is very low. Okay? So the answer is only 1 and 2. 1 and 2. Got it, everyone? Very important. These are all the important questions which you will see in the exams directly. Okay? Off balance sheet exposures are dash in nature. Now this is a simple question. Off balance sheet. What is off balance sheet? Off balance sheet means those which cannot be shown in the balance sheet. Means what? What cannot be shown in balance sheet? See this. Let me give you a simple example. Balance sheet and off balance sheet. Off balance sheet. Okay. So in balance sheet, what do we have? Balance sheet. Cash credit, CC, term loan. These are there in balance sheet. Means where cash is given. See the loans, CC and term loan, directly cash is given out. So that can be shown in the balance sheet because balance sheet includes money. But my bank guarantee, BG, bank guarantee or LC, letter of credit, Do I give actual money in this? No, I don't give any money. I just give the word commitment. एक बार जो कमिटमेंट कर दिया तो मैं खुद की भी नहीं सुनता. Commitment. So this commitment, this logic is shown in this off balance sheet items. So off balance sheet exposures are which, so now look at this only, these two, bank guarantee and LC. These are what type of instruments? Risky, profitable, contingent and operational. Now you'll say risky. Risky is everything is risky in banking. Everything is risky in banking. That's why we are there, isn't it? But that is calculated risk. So this question is out. Risk is out. Profitable. What is profitable? Of course, it should be profitable. That's why you are there in the banking. If something is not profitable, why are you doing it? Isn't it? So that is the point. So these two answers out. Contingent. Now what is contingent? This is the right answer. Because contingent means what? In contingent liability means future. Right now, there is no risk. But in future it might come up. Means whenever I give the LC, what do you mean by LC? I am giving a guarantee to somebody that you send me the documents, I will pay you. In future, not right now. Bank guarantee. What am I telling in bank guarantee? That if this person X doesn't perform, then I will pay you. If means it's all future. So that's why this is called as contingent. So it is contingent liability. Okay. So off balance sheet exposures are contingent in nature. Operational is obviously operational. Everything is operational. You do anything. In the end it comes to operations only. Okay. So the correct answer is contingent. Got it? Read this. Which of the following organization is responsible? It is responsible for developing and administering benchmarks related to money market, government securities and foreign exchange of India. So which of the organizations is responsible for developing benchmarks here? The main word over here is remain. What happens is, I'll tell you, in such big questions, we lose the important word. What is to be checked? You go on reading organizations responsible for developing and administering. You are so much engrossed in this administering, developing that you forget to focus on this word, that is benchmark. Once I say benchmark, there are only two benchmarks. Immediately it should strike your mind. There are only two benchmarks. One is given by RBI, second is given by. That is the question. So benchmarks relating to money market, government securities and foreign exchange of India. So fixed income money market derivatives association of India, FIMDA. Foreign exchange dealers association of India, FEDI. Indian Banks Association and FBI, a joint venture between FIMDA, FEDI and IBA. So who's the correct one over here? Who gives the benchmarks? Here, let me explain you. Benchmarks are given by two parties in our country. Benchmark, okay? Benchmarks are given by two parties. Who are the two parties? In fact, see this. Let me go a bit deeper in this. Benchmarks are of two types. One is internal, and second one is external. Okay? These are the two benchmarks, internal and external. Internal is developed by the bank itself. Bank designs its own benchmark. That is known as mainly MCLR nowadays. MCLR, marginal cost of lending rates. You might have read about this MCLR, or you might recall it now. External benchmark is of two types. Okay, one is given by RBI, and second is given by FBIL. Financial Benchmark India Private Limited. Financial Benchmark India Private Limited. So what is the benchmark given by RBI? RBI gives repo. RBI's benchmark is repo. And FBI's benchmark is FBIL. Means it has the name as FBIL repo, FBIL this, FBIL, all this FBIL name is there. Okay. So benchmarks are given, kindly note this one very important term. Benchmarks for any bank, any lending are of two types, internal and external. Okay. Internal benchmark is designed by the bank itself, MCLR, marginal cost of lending rates. Okay. There are four components to it. You might be knowing this, right? Four components. What are the four components of MCLR? It is MNOP. Okay. Now I won't go into details of that because it will take a lot of time then. Okay. So negative carry is there. Then what? Operating cost is there. Tenor premium is there. Right. Marginal rate of lending. These are the four MCLR components. FBI. This external is related to RBI and FBI. RBI gives repo. All the repos are of various terms nowadays. Repos are not overnight now only. They have gone beyond up to 3 months. Repos are there. And FBIL. FBIL will give the benchmark. It is designated by these three companies, FIMDA, FEDE and IBA. Okay. Even RBI also has the stake in this. So it is basically given, this company is developed by these 3-4 companies. So that's why they give you the external benchmark. Banks can follow either this or this. Anyone they can follow. Generally banks follow RBI. They don't follow FBI. Generally I am saying. Okay. So the answer for this is this, FBI, joint venture. Okay. This is the answer. Okay. Now before going, let me show you how to join the batches here. These questions are some of them. I'll be sharing these question banks with you in the paid classes. So join the paid classes immediately. How to join it? See this. Go to Adda 24/7. Always I'll suggest you to go through the app. In the app you will be getting 1% extra. Go to Adda 24/7. Click on JIB and CIB to get this. Click on JIB and CIB over here. Now you will see CIB June 25. Click on CIB June 25. Okay. Look at the batch. Focus batch. Join this focus batch starting on 21st. Okay. It has not yet started. Just 2-3 days. Now it will start. Join this batch. Fresh batch. All the ebooks, test series, everything is given. Plus, you will be having all the MCQs solved, means important theories explained. This question banks given. So everything you have it. Okay. Trained staff means I myself have more than almost 13-14 years of experience in teaching BFM only. AB and BFM. So I know ins and outs of this topic. Okay. So ebooks, mocks, tests, everything is given. Now how to join it? See this. Click on buy now. And remember the code Y432. 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 Okay, never forget this code Y432. Click on enter. Look at this. 80% discount you are getting plus 1% extra using the coin systems. Okay, so 81% net you are getting. So join this focus batch ASAP immediately now. Okay, because only few days are left. The batch is starting now. Okay.